Analyzing competitors by comparing financial statements is an essential practice in business, providing valuable insights into how a company measures up against others in the same industry. By examining key financial documents such as the statement of financial position, profit and loss accounts, and cash flow statements from competitors, businesses can identify strengths, weaknesses, and opportunities within their own operations. This comparison allows businesses to assess their performance not just in isolation, but within the context of the broader market. For instance, a company may compare its statement of financial position with that of a direct competitor to evaluate relative asset management, capital structure, and liability levels. If one competitor shows significantly higher fixed assets, such as factories or equipment, it may indicate a greater focus on production capacity or long-term investment in infrastructure. This might suggest that the competitor is better positioned to increase output or improve efficiency, giving them a competitive edge in the market. Conversely, if a company holds higher levels of current assets, such as cash or stock, it may indicate a stronger liquidity position, enabling it to respond more quickly to market changes or invest in opportunities. Profit and loss accounts can also be compared to gauge profitability. A company may observe that a competitor has a higher gross profit margin, indicating that it manages its production costs more efficiently or charges higher prices for its goods or services. This analysis could prompt the company to review its own pricing strategy or cost control measures. Alternatively, if a competitor has significantly lower operating expenses, it could reveal a more streamlined business model, possibly through the use of automation or better negotiation with suppliers. Cash flow statements provide another point of comparison. A company with strong cash flows compared to its competitors is likely better equipped to reinvest in the business, repay debt, or pay dividends to shareholders. This could indicate a more robust business model or more effective management of working capital. A comparison of cash flow from operating activities, in particular, can show how effectively each company generates cash from its core business operations, revealing which is more efficient at turning sales into cash. Additionally, the analysis of shareholders' funds and long-term liabilities can highlight differences in how companies finance their operations. A competitor with a lower level of debt relative to its assets may be seen as less risky, while a company with higher retained profits might be reinvesting more aggressively for future growth. For example, if a competitor shows a rapid increase in retained earnings while the business in question lags behind, this could indicate that the competitor is generating stronger profits or managing its finances more effectively to support growth. Beyond these direct financial comparisons, analyzing competitors' financial statements can also provide insights into broader strategic decisions. For instance, significant investments in research and development or marketing might be visible through higher intangible assets or operating expenses. A competitor that consistently reinvests in these areas may be positioning itself for future market leadership through innovation or brand building, and this strategic shift can be inferred from the financial data. In conclusion, comparing financial statements from competitors allows businesses to gain a detailed understanding of where they stand in relation to others in the industry. It can reveal differences in asset management, profitability, cash flow generation, and capital structure, all of which can inform strategic decisions. Through this analysis, businesses can not only identify areas where they are lagging behind but also discover opportunities to improve and possibly outperform their competitors.